Now, those of you that were here last year, like Terry, will recall, because Terry's got a very good memory, he will recall that I had a signpost up there that basically said nothing much has happened right from the 30th of June. This year, you'll get my subliminal message about the minor, so you've automatically come to the conclusion that there are only minor changes to accounting standards for 30th of June this year. Now, it could have been a bit more aggressive in that space and had rats and mice pictures, but I didn't think that rats and mice would go particularly well over breakfast. So we have 5 accounting standards there. I just wanted to put them up, and we'll cover off these minor changes in the Hall Chadwick winter edition of their newsletter, The Corporate Advisor. But there's nothing much in those standards that are going to impact you. One or two of these nuances might. So they're minor amendments at the end of the day, nothing fundamental in that space. The only one that I really want to draw your attention to is AASB 101, presentation of financial statements. And there are some changes there that are symptomatic of changes that are going to be installed in terms of better communicating in the financial report. Because what the International Accounting Standards Board wants to do is improve the quality of financial reporting going forward and issues in relation to materiality that I discussed last year. So the amendments to AASB 101 are simply designed to remove any actual or perceived barriers to improve you streamlining your financial reports. And a number of entities have streamlined their financial reports, for example, by not following the standard format of the accounts, your accounting policy note, followed by all the other notes in the sort of sequence, but reorganising that into how your business operates. It's called streamlining, and there will perceived to be a number of barriers in AASB 101 that prevented those issues. So I want to move on to the key standards in this space. They're both younger looking ladies. The one on my left-hand side is Carmen Ridley, part of my team, current member of the Australian Accounting Standards Board, who works with Graham and Sadiq on those more complex issues. So this is where the rubber starts to hit the road. These are the accounting standards that are coming through as at 30th of June for the next 4 years. And I can add to that 2021 when we have a new standard, AASB 17, on insurance contracts. So this is the biggest change in accounting standards since we moved to IFRS in 2005, 2006. And it's a darn set more complicated than the move to IFRS, as you will see with some of my slides. So I see in the audience that there is a sort of a sigh of, still a way off. I've got some time, you know, the new standards on revenue, financial instruments and leases, or even revenue for not-for-profits. That's a way off. I don't have to worry. That's not really true. You can be lulled into a false sense of security by these deadlines. So something to look forward to. I'm passionate about financial reporting. I'm enjoying these new accounting standards coming through, not only because they're good for business, but just for the way that financial reporting is evolving and understanding these accounting standards. So it appeals to my warm sense of humour. So if we look at two standards, for example, AASB 15, revenue. Hopefully you all have revenue. It's revenue from goods and services, so 98% of you in the audience will have revenue from goods and services. AASB 9 is financial instruments, and every time we talk about financial instruments, people say, well, I really don't understand that term. So if I talk about debtors, investments and the like, you get the idea of what financial instruments are. So what I've done with this particular slide is work back from those dates on the previous sort of bar chart about when they become operative and put them into 31st of December year end and the 30th of June year end. Because international accounting standards are based on a December year end, if you've got a December year end, you're going to be the first cab off the rank. So if we look at those two standards, we work back. The go date is when they will appear formally in your financial statements as 31 December 2018. So you're saying, well, that's still a little way off. Well, then we go back a little bit further and say, well, these standards have requirements for comparatives and the like. So we go into 31 December year end. So that's 31 December 2016. Well, that's sort of 8 months off from now. So we're getting a bit closer to needing to do something. We go to 1 January 2017. When was 1 January? That was sort of 5 months ago, eh? At 1 January, we have our transition into these accounting standards. So that's when you're supposed to prepare an opening balance sheet in compliance with the accounting standard. And I dare not ask the question of the December year ends about how many of them have done their opening balance sheet. So that opening balance sheet really needs to be in compliance with those accounting standards. The opening balance, so you've got to know the accounting standard, you've got to work out the entries, you've got to have the information, you've got to make the decisions on the transitional arrangements in those accounting standards. So what of you will be behind the mark? In relation to AASB 15, what the standard setters did, they gave you an extra year, because normally accounting standards have a 2-year window before they're operative. They gave you 3 years because the AASB 15 is a tough standard to implement. I'll give some examples later on why. And you squandered that additional year, so you're going to be pedalling very hard this year and next year to get on top of AASB 15. And with AASB 15 comes AASB 9 financial instruments. And there are changes there to the classification to those that hedge and to those impairment calculations. So there is a fair bit to do in that space. So hopefully one of the things you'll take out of today's presentation, other than common sense of humour to a corner, will be that I've got to really get on top of these issues sooner rather than later. Now, AASB 15 is a completely new way of looking at revenue recognition. As I said before, you all will have revenue for goods and services unless you're in the financial instruments area where you have revenue from those financial instruments. So anytime you have a good and services, you're caught by this particular accounting standard. The old accounting standard dates back to the 1980s, when essentially the International Accounting Standards Board back then cobbled together what was accepted practice. So it was a very high-level accounting standard. Now, under this accounting standard, it's far more challenging and covers far more scenarios than the old standard. So if we look at have you started to think about this, and from the number of presentations that we've done, the answer is that most entities still are oblivious to this accounting standard. A number of people that we've had discussions with say that it doesn't affect me without doing any analysis of whether or not it affects them. So what I've done is a series of dashes below that, just put these issues up to prompt you. Do you have any of these? And if you do, this accounting standard applies. and will change the way that you recognise your revenue. So discounts, rebates, claims, incentives. If I'm a construction entity, I have construction costs. There's a different way of accounting for those. There's a new term, performance obligations. I wonder what they are. The issue of control. These are new terms in the context of AASB 15. If I can take you to the overlying principle of this standard, it's really to recognise revenue in the way that we transfer the goods and services to another, to the customer at the end of the day. It's an entirely different way of looking at revenue recognition from the risk and rewards approach under our existing standard. So entirely different way. So if you have revenue from goods and services, the whole system of revenue recognition changes. Also, there is the issue with that word expected. What is our expected consideration from the supply of those goods and services? That expected consideration can vary for all those reasons in the previous slides. Incentives, discounts, and the like. So we have a real element there of forward-looking aspects of our revenue. So with the word expected, we find a number of judgments coming through. If we look at the five-step process, and what I want to do with this accounting standard is really just focus in today on a little bit on steps 1 and 2 to give you a feel for the particular accounting standard. Because if you get steps 1 and 2 wrong, then the rest don't matter because you're so far off the mark. So I thought I would just stress some of the issues with steps 1 and 2. So 5-step process. In the majority of cases, what will happen is that your revenue will be deferred more than under the current accounting standard. So that's one of the key messages for preparers to take away, that this standard will result in revenue deferral. Very few circumstances that we've come up with to date on our consulting and training has seen an acceleration of revenue. So if you're in the construction industry and the like, you will see deferral. The only area that we've seen revenue being recognised earlier is in the telecommunication industry. And there aren't, I don't think, any in the audience today in that particular area. So you just think about those stakeholders of yours that are used to seeing the revenue grow and the like, they're now going to see a significant part of that deferred. So that's one of the lessons to take away from today. If we look at the accounting standard itself, it is different from what we know. The current accounting standard, including the leasing standard, they go together in around about 40 odd pages. The new one is in itself 48 pages, so not significantly different in terms of the quantity of pages, but significantly different in the revenue recognition model itself. I want to take you down to the third bullet point because this is where I'd really like you to start if you're going to read the accounting standard. The basis of conclusion. You get the basis of conclusion by going on the AASB website and clicking on the button extra. So that'll give you this insight into the accounting standards. And basically it was all the key decisions and why the AASB made its decisions on this accounting standard. And it's relatively easy to read because if you just read the accounting standard off the top, it may be gobbledygook to you because it's so different from what we currently do. So you're reading this and you're saying, gee, what does that really mean? So if I was a preparer and the like, I would start off with the basis of conclusions, then work my way through to the accounting standard and all the other literature. I also suggest you have a look at the illustrative examples. and there are 63 illustrative examples on revenue recognition. And that, to my mind, gives you, or should give you, some good idea of the number of nuances or changes there are on this accounting standard. So what's going to change, other than my general sweeping statement about deferral of revenue at the end of the day? Your accounting systems are going to have to be revised to reflect these changes, because you can't do all these changes manually. So how long is it going to take you to revise your accounting system? How are you going to collect the new data that is required to meet the disclosure requirements of this standard? If I asked you, where are all your contracts with customers at the current time, could you tell me where they are? Do you have a contract register? Sometimes the accounting department is not where the contracts reside. In terms of contracts, one of our New Zealand clients, a construction company, has 1,100 contracts. This accounting standard requires you to account for contracts on contract by contract basis. It does allow, as a practical expedient, for you to aggregate similar contracts into a portfolio regime where terms and conditions and performance obligations are similar. So you just think about how many contracts you have. Are they the same? Are they different? Is there information outside the contract that has a bearing on that contract? In other words, our normal customary business practices that perhaps aren't reflected in the contract, but are reflected on the website. For example, we might be providing discounts, and the discounts aren't mentioned in the contract, but they're mentioned on the website. Or perhaps we have had some discussion with a customer, and these discussions are reflected in the emails and the like. So you've really got to know what the contract is and the facts and circumstances around those particular contracts. This change of accounting standards can affect so many things. It can affect the bonuses where they're in any way linked to revenue, profit or EBITDA. They're linked to your bank covenants. Now normally bank covenants will say that bank covenants are unaffected by any change in accounting standards, but I suggest you look at your bank covenants. So some points that I want to stress. This is a complex accounting standard. And to give you an idea of the complexity of the accounting standard, yesterday here in Sydney, my colleague and I held a full-day masterclass on this accounting standard. Now, that was one full day, and this was mainly on the theory, but with some examples. Our preferred, or the next iteration of our work in this space will be that one-day masterclass followed by a half day of workshops, activities for people to go through to make sure that they understand the requirements. So just by giving a simple example, we think that there's a lot of work in this, depending upon your particular business. A number of, a couple of you in the audience are in the construction contract industry, and I make 2 points. One, that milestones in a contract or a construction contract are not the basis for revenue recognition, because they are more about cash flows. They are not performance obligations. Performance obligations are what you promise in a contract, and that's how we account for revenue in this standard. So milestones are not performance obligations. Important point to note, because many get confused on that issue. Milestones are when we get paid under the contract. They don't align to performance obligations. The second point is that many of you in the service industry, how do you account for those services that span the reporting period? You account for them on the stage of completion. The stage of completion is not a performance obligation under this accounting standard either. So you don't get to apply the stage of completion to the delivery of services. Again, you need to identify the performance obligation, and the revenue recognition is based upon the discharge of those performance obligations. Talk about asset recognition and impairment. Under the existing construction contract standard, we require contract costs to be capitalised, and that's solely in relation to the construction contract standard. Now under IASB 15, that issue of capitalisation of tenders and the like costs are now capitalised by service industries that aren't in the construction industry. So do you have the systems to track that particular information? Also, as an asset, it's subject to the asset impairment requirements of IASB 136. SPA, share purchase agreements, earn-outs and warranties. Often these will be tied to a revenue number at the end of the day. And therefore, this new accounting standard is going to affect any of those earn-outs where you have a revenue number. How are you going to calculate that revenue number on the old accounting standard or the new accounting standard? It's an area ripe for litigation. Special purpose financial reports. A number of you will be preparing special purpose financial reports. If you follow the views of ASIC and the ACNC on those special purpose financial reports, you apply the recognition and measurement requirements. So this is a recognition and measurement requirement, so it's going to affect your special purpose financial reports. One or two not-for-profit entities in the audience today, and there are size thresholds, as there is with ASIC. The size threshold determine your requirements for reporting and auditing at the end of the day. These suite of accounting standards can affect those size threshold and therefore your obligations. So much happens in this space. The first thing is to identify the contract. So I'm only going to briefly do with steps 1 and 2 of the 5-step process so that you get a feel for the accounting standard and some of the complexities associated with that. So let's go to the fundamental issue about what a contract is. A contract, as you know, is an agreement between two or more parties that creates enforceable rights and obligations. So we need to go through the contract and extract the information that will allow the application of this accounting standard. So we've got to understand the contract of enforceable rights and obligations. Now the next part is that it says, well, these are enforceable rights and obligations under the law at the end of the day. So what we do to Gap Consulting is to improve the breadth and depth of the audit team, and in relation to IASB 15 is to have a lawyer that can help us with identifying those rights and obligations where necessary. It's important to note that we're not just looking at written contracts, we're also looking at what's implied. That could be from those other facts and circumstances surrounding how that contract was developed, and can also be verbal at the end of the day. I got a coffee downstairs. I didn't sign a contract, a written contract, but we got a coffee. It was verbal, but that met all the requirements of a contract. And importantly, the standard goes on to say practices and processes around the various industries in which you operate will also be a determinant of that particular contract. And just think if you're a significant entity with overseas jurisdictions, and those contracts are written in those overseas jurisdictions, that you have to be cognizant of the fact of the legal implications in that jurisdiction, unless there is a clause in the contract that says, for all intents and purposes, you use Australian law. So there are many variations in this, or nuances for this accounting standard. So we need to consider the terms of the contracts. So getting back to my earlier point, you need to get a handle on where all your contracts are, and not an easy part. Then we need to identify all facts and circumstances around that particular contract. Do I have all the background information that gives me the entire picture of how this contract was in fact determined and what the accounting is? Now, what we've found from our practice is that a number of entities have incorrectly accounted for revenue in the past. So that is an added complication. So don't be surprised when you start to dig back into some of these contracts and look at whether or not you applied AASB 18. You may well find that it's incorrect because the previous accountant in the organisation didn't get it right. So be very mindful that we've had quite a number of examples where the existing revenue recognition policies have been incorrect. You can, the standard really takes you down the path of applying the contract on a contract by contract basis. That is what they term as a practical expedient. It allows you to group similar contracts. So for that entity that I mentioned in New Zealand that had over 1,100 contracts, it's proving quite a challenge because each of those contracts are different and there isn't a great deal of similarity. So they're really going through what are their material contracts, what contracts have significant deferrals of performance obligations, what contracts have losses and the like. So they sort of stratified their contracts to help manage getting through that 1,100. So for the contracts, what I envisage preparers doing at the end of the day, first of all, getting them all and all the information around those contracts. Over the top of that contract, having a template by which they're going to extract information about the contract, its payments, terms, and what rights and obligations there are under that contract, payment terms, so that that information can be extracted and fed into the accounting system. So just remember how many contracts you have, because the auditors, or Chadwick, when they come around and do the audit, will be looking at the extraction of information to see that it reflects the underlying requirements of the contract. There's got to be a customer at the end of the day. If we don't have a customer, we'll be into another accounting standard. I've put this particular slide up for a variety of reasons. One, it is to remind everyone of contract law, AASB, contract law 101. And there must be the intention, there must be the offer, there must be acceptance and consideration for there to be a contract. If I'm to identify a contract, we have a requirement now where the 6 threshold tests must be met. So you've got to have in your accounting system a monitoring control for these particular 6 items. Where those 6 items are not met, it is not, you cannot recognise revenue under this accounting standard. So if you meet 3 out of the 6 at the end of the reporting period, you don't recognise the revenue. There is 1 or 2 exceptions to that general principle, but you can't. Then what you do at the next reporting period is you see how we've progressed to meet those particular requirements. So a core aspect of the new accounting standard. Step 2 talks about identifying the performance obligations. And performance obligations is a new term and basically means what did we promise to do under that accounting standard? What were our promises? What were we going to deliver to the client to benefit the client? So we need to go through our contracts and identify performance obligations. We're having the discussion yesterday about how many performance obligations would there be in a contract. And in the more complex ones, we came up with around about 6. So we need to identify those performance obligations, because once we meet those performance obligations and transfer an asset to a client, then we start the process of revenue recognition. And now sometimes a number of those performance obligations are quite small, so we can aggregate those performance obligations. Other performance obligations are a bit more complex. We've got to pull those apart. The performance obligations sometimes are explicit, they're readily identifiable, or they're implicit because of all the other items around the particular contract, the facts and circumstances. Now, steps 1 and step 2 are critical. If you don't get those right, all the other steps will be wrong. So it's important to understand finding the contract and identifying the performance obligations. Now, the problem with a number of contracts is your contracts will be well and truly dated, and therefore will have no direct linkage to this accounting standard in terms that they were not written with AASB 15 in mind. So identification of the performance obligations is somewhat difficult. And we bamboozled our audience yesterday with a couple of case studies when we asked them to identify the performance obligations because they were difficult to find. So one of the consequences of this accounting standard is to relook at the contracts and see whether or not they need to be rewritten for clarity, or for any new contract being entered into from here on in to quite clearly identify the performance obligations. So that is a task in itself. The standard requires items to be distinct for the purpose of performance obligations. So we have to be giving the customer a benefit at the end of the day. So we've got to think about the implications of these accounting standards. So the accounting standard describes what a benefit to a customer is, and essentially it is something that the customer can use or apply immediately in relation to that performance obligation, or in conjunction with a number of other assets that the entity has. Again, these are meant to give you an idea of the complexity, not explain the accounting standard. So if we can't separately identify the performance obligations, we've got to go through and consider these particular items. Then we also need to consider whether or not the performance obligations are highly independent and highly interrelated. So there's more decision making, more rules around that particular item. Do you guys have service warranties at the end of the day as part of your business? Service warranty is a separate performance obligation and is accounted for separately. I've mentioned the milestone payments. The milestone payments are not performance obligations at the end of the day. So don't get confused on that. A phone call from a Sydney firm of auditors, and the partner said, look, I'm reviewing a contract here. I'm charging the client $10,000 to review that particular contract, and I'm really confused, Colin. said, well, that's only natural because this is early days of this. And I said, what are you confused about? He said, I'm confused about the performance obligations and milestones. I said, well, I'll set you on the right path, that the milestones are not performance obligations. So he was really happy that he clarified that. There's going to be all these very simple questions that people will want assurance on. The next part is, do you have non-refundable upfront fees? Because what do we do with non-refundable upfront fees at the current time? We generally pocket them when we get those particular fees in. And a number of you are parents of kids attending schools, and you pay waitlist fees and the like for those. Schools have a great way of extracting as much cash from prospective parents as possible. So have you ever thought about how they account for those upfront fees? And they account for those upfront fees on the basis of debit cash, credit revenue. Now, any time you have a fee, a joining fee, an activation fee, a set-up or a registration fee, a mobilisation fee for services, and they are non-refundable, those fees can no longer be recognised as revenue upfront. They're spread over the contract period or the performance obligations which they relate. So that's a big change for some entities. We've been doing works with a couple of gyms alike. Many work out of gyms, you pay that upfront fee. Those fees now get spread. An important aspect is whether or not you're acting as principal or agent in a particular agreement. Now, if you're acting as agent in an agreement, you're not recognising revenue from the sale of that good or service. You are recognising your commission on that particular transaction. What we've found in practice is that a number of entities have not correctly identified whether or not they're acting as principal or agent. Sort of no effect on profit as such, but an effect on your revenue and how you portray your business. So that has been a stumbling block of a number of entities. And I'll put those couple of points there to help you identify whether or not you're acting as principal or agent. Now, with these, with those particular points, it's not that you have to meet all three or all two. You'll make an assessment as to whether or not you're principal or agent. So there are 101 things to do. So a fair bit of training and education will be required in relation to this standard. Also IASB 9, IASB 17 on leases. So training and education, not just of yourself, but of your board, because a number of it, also it's been quite obvious to us that a number of boards have not understood their existing accounting and have been surprised when errors have cropped up. So the board needs some high-level training on what this standard does. The next part on information gathering, by an example of saying to you, do you know where your contracts are? Do you have all the facts and circumstances around that process? So you're going to have to go on an evidence gathering basis. And you're going to really start off with how did these entries, these cash entries, get into the general ledger and source them back. We're going to review the contracts to extract the information to meet this accounting standard. We're going to have an accounting policy for each of our revenue streams under this accounting standard. And I don't mean your summary of accounting policies in Note 1. I have the expectation that you will have a detailed accounting policy that will describe how you recognise your revenue for the various types of goods and services that you provide. So if you had, for example, 6 revenue streams arising from different contracts under the standard, I would expect your accounting policies manual to tell me about each of those revenue streams and have the judgments that you're made on the application of that accounting standard. Because you as preparers cannot sign off on a set of accounts in terms of compliance with accounting standards unless you have detailed accounting policy. There are a number of large disclosures in this standard in comparison to the existing accounting standard. You'll need to have the systems in place to extract that information and to make it as painless as possible, because every year you don't want to go through and manually extract that information. This accounting standard is going to change the way your financial statements look and the key performance numbers. So it's very important that you communicate with people about the forthcoming changes. The slide builds on the previous one. I just want to deal with the transition arrangements. Each one of these new accounting standards has transitionary arrangements. That means we need to make some decisions when we're moving into this accounting standard about, in this case, comparative figures. There are also a number of practical expedients, things we can do quickly, or options in the transitional arrangements. So we need to go through the transitional arrangements and make some decisions. So again, I have the expectation that you will have considered read those transitional arrangements and made some decisions about which options you have. Again, they will be documented because Graham need to see evidence of those. If I look at income from not-for-profits for a moment. If I'm a not-for-profit and I have a contract with a customer, then I'm in AASB 15, which allows me, in essence, to defer revenue, which I wouldn't have done in the past. So we have, in essence, around about 4 dimensions of this standard. First of all, I'll jump down to the third bullet point. What the Australian Accounting Standards Board did was include an appendix in AASB 15 specifically for not-for-profits to understand how this standard works in terms of contract identification for a not-for-profit. Because the language in this accounting standard is written in a for-profit standard, because that's what international accounting standards do, just for profits, the Australian Board, because it has a wider ambit, for not-for-profits, needed to explain how the standard could be applied. So when you're looking at the standard, go to and say, well, this doesn't really apply, it doesn't gel the language and the like. You go to the not-for-profit appendix, I think it's Appendix F or Appendix G, and that'll give you that language that will help you understand that accounting standard. So that's an Australian equivalent. And if I go to the next one up, in essence, because the AASB released these not-for-profit standards just before Christmas, because they like to give Christmas presents, you got a 1-year deferral. So those dates that I dealt with earlier on, you've got a year later. Don't do what the number of the corporates have done and waste that year. Start to think about how the standard is going to impact you. And then we have AASB 1058, which deals with all the income of not-for-profits that's not covered by 15. And so this is a new standard. And in essence, what the board tried to do in that space, this is in relation to government grants in particular, what the board did is considered and wrote a an Australian accounting standard, so it doesn't have any international comparison, but applying the principles in AASB 15. So in essence, what 1058 gives the not-for-profit entities is a deferral of revenue, not based on matching, not based on time, but deferral based upon the completion of performance obligations. So from 1 January 2019, this accounting standard applies, so you need to work back for the comparative period, and then that start of the comparative period is your transition balance sheet. There is still AASB 1004, but in essence, that standard has been gutted because it has been superseded by 15 and 1058. There are just some minor legacy issues in that accounting standard that essentially applies to the government sector. I'll move on and deal with financial instruments. We all have financial instruments. They're going to be receivables or your investments. There are three principal changes to this accounting standard that will affect each entity differently. One, the classifications that we have grown accustomed to under the existing AASB 139 have changed to make life a little bit simpler. The available for sale category is disappeared. As you'll see by the next slide, we're so if one of the points that I wanted to bring out as the third bullet point, that all the equity instruments are to be carried at fair value under the existing AASB 139, they're at cost. So if you have any equity instruments on your balance sheet that are at cost, they'll need to be revalued. The next point that I want to touch on is that the classification of assets very much depends upon your business model. So what anyone would be looking for at this stage is to see what your business model actually is, and your business model determines the accounting in accordance with those principles. If I'm looking at the measurement requirements, the measurement rules differ for equity instruments depending upon whether or not they're going through OCI. OCI is jargon for other comprehensive income changes. If I'm looking at hedge accounting, these rules have been changed to remove some of the bright lines that were in AASB 139 over hedge effectiveness, and basically allow hedge accounting to be applied in conjunction with what are your risk management practices. So if you're into this area of accounting at the end of the day, your accounting policy, your internal accounting policies in relation to hedging and that will require a degree of revision and specification to apply the new rules. The new rules, in essence, want to align hedge accounting with your risk profile, risk management profile. If we talk about impairment of financial assets, what are the rules in relation to impairment of financial assets at the current time under AASB 139? You have to have an event that triggers a consideration of whether or not we have an impairment loss. So that's a fact that happens in the marketplace, like the global financial crisis and the like. That model is completely changed under the new accounting standard. Under the new accounting standard, the impairment assessment, if you like, is not made when there is a trigger event, but it's made when you raise the invoice. What is the expectation but I'll have a credit loss associated with that invoice. So again, to draw a brief contrast to the existing accounting standard, I need an event to see whether or not there is an impairment loss. If there's no event, then there's no impairment loss. But under the new standard, the loss incurred model, expected losses incurred model, I have to make that assessment for every invoice or collective group of invoices for the entity. So it changes from being a one-off event to a continuous process. This is a very complicated area, and the financial institutions will be far better placed to make those assessments than a number of the business type of entities, because you won't have the track record of bad debt experiences and the like. So this is a complex area of itself. If I can now just briefly move on to leases. This applies from 1 January 2019. Does anyone not have leases? Put up your hand. Anyone not have leases? Good. So maybe one. So I'll just speak to the issues under this accounting standard, and just skip the number of slides there for your future reference. I recall a story from Sir David Tweedy. Sir David was ex-chairman of the International Accounting Standards Board. He was Scottish and he was known for his very quick sense of humour. I can share two jokes with you in that regard. One, the difference between an auditor and a shopping trolley. Shopping trolley has a mind of its own. David Tweedy. With all due respect to my good friends, Peter and Chadwick, they do have minds of their own. And one of his other quips was, before he finished his tenure as chairman of the International Accounting Standards Board, he wanted to fly on someone's plane that was on their balance sheet. Unfortunately, he retired a number of years ago, so he never got to see that in his tenure as chairman. So basically, with our existing accounting standard, there've been the leasing agreements have been designed to keep items off balance sheet, so they've been shown that it's an operating lease. By the way, that accounting is fundamentally flawed because preparers and auditors have not been applying the accounting standard that should have been applied. Because I would have reached the conclusion that many of those operating leases were in substance finance leases and should have been recognised. But practice was that they weren't. That was not the correct account. So what the International Accounting Standards Board decided to do was it was about time we fixed this issue, because analysts of financial statements were using the disclosure of the operating leases to figure out the effect, and that really wasn't helping users of financial statements because they're very much arbitrary decisions. So all leases are on balance sheet except for a number of small exclusions. And in essence, what the problem was that these are US numbers, that there were $3.3 trillion worth of operating leases that were reflected on the balance sheet. So significant changes are coming through. 85% aren't on the balance sheet. And again, to be quite upfront with you, the leasing standard has attracted a lot of attention because people find it easier to get their mind around the fact that we have operating leases and they now come on balance sheet. So a lot of interest in leases. The same degree of interest is not evident in AASB 15 revenue from customer contracts. So, because we need to turn that around, because like I said, everyone, or almost everyone, has revenue from customer contracts. So the headlines of what is changing. So not only are we going to have the leases on balance sheet, and they're going to be called a right, a user right, a tangible asset at the end of the day. The method of calculating our lease asset and lease liability is changed from AASB, current standard AASB 117. So the methodology is going to change. So we're not just, if you like, taking what we said as the operating lease in the accounts at the current time and just capitalising that. We're applying a whole new regime to that leases. So the leasing standard in itself is a complicated accounting standard. I mentioned to you that we run master classes on revenue that take a day. The new leasing standard also takes a day to get an understanding of its requirements. As a result of changing to putting the leases on the balance sheet, we have a number of positive effects. For those that you are EBITDA orientated, the accounting standard requires the lease to be depreciated over its economic life. So that affects the EBITDA. Let's deal with two exceptions to the capitalisation of leases. If I've got a lease for 12 months, I don't need to capitalise. If I've got a low value asset, and a low value asset is described, and it's just an indicator in the basis of conclusion to be about 5,000 US. So if I have a number of low value items in my lease, individual assets, not individual leases, of low value, then I can just continue to treat those as operating leases. So you might have a number of computers or mobile phones that each has a value less than 5,000 US. Even though they might add up to millions under the contract, you can still apply the low value options. They're options, they're not mandatory. So if I look at the fundamental principle of the standard, I have a right to use asset, which is the lease. It's a tangible asset, not an intangible asset, which is good news for those that have NTA responsibilities and lease liability. We turn around to the income statement, we now have an interest expense and a depreciation expense. So obviously good for EBITDA. We have impairment considerations on the right to use asset because it is an asset and subject to AASB 136 requirements. We also have the complexities associated with variable lease consideration. The statement of cash flows will change because of those recognition on the income statement. Sometimes when we're looking at a lease, it doesn't have to be called a lease, it can be in an agreement with a lease component. So we need to go through the agreement and separate out the components of the contract. The next slide was just to give you a heads up on what we include in the measurement of the lease liability and the like. And then we turn it over to the other side. If we're looking at the right to use asset, what do we include in those particular costs? In the current accounting standard, we're not too specific on the lease term. So the accounting standard basically says to us these are the issues that we need to consider because the lease term is going to be the period over which we determine depreciation and the like. So the non-cancelable period of the lease, The optional renewal periods if reasonably certain, so that's another judgment call in the accountant. So we might have option periods of 5 by 5 by 5. How many of those periods are reasonably certain? That's a high threshold, reasonably certain. It's not probable, reasonably certain. So what we should be looking at is the business case, why we entered into that lease, how did it line up to our long-term strategic plan. At the date of going into that lease, was our intention really to go 5 by 5 by 5, or were we really going 5 by 5 and then the last 5 we weren't sure? So it really requires an understanding of the business rationale for the lease and the like. So some interesting issues. I put in a slide here on the positive an impact on ratios, because a number of borrowing covenants are in relation to ratios. So in my previous part of the presentation, I referred to understanding the borrowing covenants and the effects. So you need to go through your banking covenants and at least have the discussion with the banks about how these may affect them or not. Banks don't like surprises, so if you have that discussion with them, even if the banking covenants allow for changes in accounting standards, I always think it's prudent to say to the bank, we'll run some numbers, these are how our financial statements are going to look, and just keeping them informed as part of our good relationship with you. Next part is I want to look at the regulatory focus about what ASIC is. Chairman up there, chairperson below for the ACNC. So it's just to touch on some issues. Now, really the good news here is that the ASIC focus areas, which Graham and Sadiq wrote about in the summer edition of the Corporate Advisor, are most likely to be the same issues that ASIC will be talking about when they release their targets and results sometime this month or early next month. So if you want to say, well, I'm starting to focus on my year-end reporting issues, what's ASIC likely to look at, go back and read the summer edition of the Corporate Advisor. When the winter edition comes out, Graham, Sadiq and I have been looking at the issues that will be communicated there, and the winter edition will be issued in July, and we'll bring you up to date with the most recent issues. Those areas of focus there have really been highly consistent with what ASIC has been focused on in the past. The major difference there is the CAMS reporting, which I'll deal with in a moment. When I spoke to you around about this time last year, I always speak about corporate restatements because the idea is to learn the lessons from corporate restatements. And the corporate restatements actually reflect the focus areas of ASIC. ASIC said we're really concerned with impairment of assets, and in particular those that are disrupted by digital disruption, and also in the mining industry since the boom has passed. And I had a slide up there last year, and I think it was something like 6 by 6, which meant that ASIC had 12 corporate restatements in that year, and we essentially have the 12 corporate restatements this year. So I flagged the entities concerned and the issues, and we see the issues related to those areas that ASIC targeting. Asset values, goodwill, and we can have a look at the numbers, and some of those numbers are horrific numbers. $161 million in relation to energy resources. We go over the page and we see how the media companies have been affected, 260 million, 254 million, $99 million by spot. So they're very large numbers. And how did ASIC come up and identify these issues? And basically it was the transparency in the financial reports. The financial reports themselves screened out that there was an issue, but the preparers did not take the write-downs they should have. So when ASIC did its surveillance program, it went back to the preparers and said, something here looks really amiss, and therefore you should write that down. So this reflects very poorly on the board, reflects very poorly on the finance team, CFOs, and also reflects poorly on the auditors. Now thankfully all you get in this space is to do a corporate restatement, a bit of embarrassment and the like, and the lessons, but the real sting in the tail there is that the law firms, the Morris Blackburns, the Slater and Gordon look at these issues and say, should they have been telegraphed to the community, to the shareholders well beforehand, and class action as a result. So the real sting is in the litigation. Now, I also don't expect that ASIC will continue just to go for corporate restatements. At a point in time, they're going to have to get tough with boards and directors themselves by imposing penalties. I've outlined some ASIC activities that I think might be of interest to you. So if you're in the prospectus space, please look at the updated guidance there. If you have AFSLs, and there are a number of AFSLs in the audience, please look at the new risk management system guidance that is operative immediately. APRA, there are some issues there, and I'll put down securitisation at the end. If you're ever involved in a securitisation, please seek expert advice, because we've been involved in a number of matters where the preparers did not understand the accounting standards and got it wrong. The auditors were also blissfully ignorant. But it wouldn't be Hall Chadwick that was blissfully ignorant. They're on top of the game. Next part I want to take you through is what ASIC is saying, and these are very important points for consideration of the accounting standards issued and not yet operative. These statements were made in the just before Christmas last year, and basically ASIC was saying to preparers, get on board with these new accounting standards, understand them. You need to make the disclosure requirements on listed and not yet operative. So each balance date that you get closer to these accounting standards, I would expect, ASIC would expect, that directors are on top of their business and know the impact. So when it comes to 30th of June this year, that there is, because these standards are only a year away, that you're a bit away, that you would have made the assessments and able to give the directional impact about how these accounting standards will affect your business, if not the monetary aspect. So some very important messages there, in particular for the listed companies, but I see the issued and not yet operative disclosures as telling me whether or not the directors and the CFO are on top of their game in understanding these changes. ASIC also said, well, directors, you need to make sure that the CFO has an implementation plan in that area. So CFOs, you don't want to be caught out by a board member saying, how are we going on that implementation of accounting standards? And you just either have marbles in your mouth or just shrug your shoulders. Not good. So be proactive. The next one is a delicate area, because there was a message to auditors at the end of the day that auditors should be mindful of their responsibilities in the context of opining on the financial statements, including any no disclosures. To maintain their independence, auditors should not be implementing new accounting standards or advising on accounting treatments for their clients. So a very strict warning from ASIC in that space. I know of a number of the large accounting firms that are skating pretty close to the wind on those issues. Should those pigeons come home to roost, there can be nothing worse than ASIC accusing an auditor of not being independent. So the idea there is that Graham and the team can act as a sounding board, assist you with training and understanding the principles, but the financial statements are, at the end of the day, your responsibilities. The directors are cert compliant with accounting standards, so the buck stops with you guys. Hard lesson. Paul Chadwick like to help, but there are limitations on what they can professionally do. So I'd just like you to understand those limitations. ASIC also has a couple of very good information releases, 183 and 203 at the end of the day. So if you're having some difficulty in getting your directors to rise to the financial reporting challenge, those two publications in particular are very helpful to remind them of their responsibilities. So my reminders on the area of the regulators, issued and not yet operative, great window into whether or not you're managing your business risks in relation to financial reporting. I spoke about the opening balance sheet being 5 months ago or a month away. Comparatives are a short-term issue, so in essence we're running 2 sets of books. If I've got interim financial reporting for my listed companies, I need to apply the new accounting standards for interim financial reporting purposes in the year in which they're first applied, so that they creep up on us. The requirements of listed companies for continuous disclosure. So if there are revenue numbers out there in the marketplace that don't reflect the new accounting standards, think you should do something about it or face the wrath of other interested parties. In relation to fundraising and other transaction documents, that these new accounting standard numbers will have to be filtered into those. And remember what ASIC said in December. The ACNC, the main message in relation to the ACNC is enforcement. Although they're a light touch regulator at the end of the day, there are some interesting numbers here. First of all, 1,300 entities with DDs, and that means double defaulters. So if you don't want your annual information statement 2 years running, you become a double defaulter. You're in essence deregistered and not allowed to access any of the benefits that go to charities. So that's a real issue for charities to monitor their compliance, otherwise they're big losers. They've also warned 4,000 charities that have not reported to date, and they run the risk of being double defaulters. Also, the ACNC can impose penalties. They do deregister charities, but only in extreme situations for a breach of their 5 corporate governance standards. And most of those corporate governance standards or those deregistrations relate to conflicts of interest, personal benefit, not running the charity as not-for-profit entity. So the charities need to have systems in place to ensure that they're compliant. And if you can just watch the space of the RSL, New South Wales Division, which is a very sorry case where the directors were prohibited from being paid directors' fees. So what they did is entered into consultancy arrangements for millions of dollars. And it's arguable as to whether or not any of those payments resulted in the actual provision of services. So a great case study in that space. Part 4, enhanced audit reporting standards. Love auditors. Someone has to. We have new audit reports that came through from 15th December, so any balance dates after that. Most of you that are 30th of June reporters, you'll come with the new audit reports. So you think, oh, it's an audit reporting issue, I really don't have to worry about that. Well, it's not really so, because a number of these issues relate to what your responsibilities are, as we see them as auditors, and also the interrelationship between what is in the financial statements and the audit report. For those in the listed space, the auditors are essentially reporting CAMs, these are key audit matters. They're the auditor's responsibility to report those. You have no oversight or veto of those issues, but the auditors will discuss those. It's part of the audit report, it's not part of management's responsibilities. And as you know, both Sandeep and Graham will consult in those particular spaces. Now, on those key audit matters, what it might well result in is you revisiting some of your disclosures in the financial statements to tell the full story, so that what is said in relation to CAMS complements at the end of the day. In relation to going concern issues, the way that the enhanced audit reporting standards work is that if you have a near miss in relation to going concern, that the auditing standard prompts full disclosures in this space. So rather than the accounting standard driving the disclosures, the auditing standard does. The next point on the standards is that we now have a specific auditing standard that tells us we have to do more work on auditing disclosures in the financial statements. So what happens, a number of entities cut and paste from a model set of accounts. That's lazy, not right, because if you cut and paste from a model set of accounts, you'll probably find that a number of the disclosures of risk, for example, under AASB 9, aren't reflective of what you're actually doing. So for all those disclosures in your financial statements that are material, you should have, again, accounting policies, detailed accounting policies underlying the information that the auditor can check off to say that's what they do at the end of the day. So one of my tips for preparers at the end of the day is really have a good look at your financial reporting and remove all unnecessary disclosures, because the auditors have got to audit the financial statements. The next point that I'll stress is that the auditors have heightened responsibilities to look at other information in the financial statements that are issued as part of the annual report or subsequently after the accounts have been signed off. So the new responsibilities there, I'm sure that Sandeep and Graham have talked to you about those. So in summary, on the auditing standards, other information, going concern, the disclosures, let's get on top of providing meaningful financial reports, the relationship between CAMS and disclosures. I think it's in your interest to have pre-issuance reviews of your financial statements as preparers, and by that I mean around about now or earlier. Your financial statements should be prepared about the numbers, and you should have someone of quality review those in terms of compliance with accounting standards as part of your quality assurance system. You should not, in my opinion, just rely upon the auditors to do that. Their responsibility is compliance with accounting standards and auditing standards. Your responsibility is to prepare meaningful financial reports to use for decision making. And you'll need to allow more time in your financial reporting processes for those changes I've mentioned above. Ethics. I've got 5 minutes left, and so I won't deal with all the half a dozen slides coming through. But I'll give these key messages to you. We have a thing called no CLAR. You say, God, I've got no idea what that is, Colin. It's non-compliance with laws and regulations. And in essence, the International Ethical Standards Board has said accountants have got to stand up because we're the custodians of the public interest. And because we're custodians of the public interest, we're going to impose new obligations on our members. We're members. And these principles manifest themselves in H110. H110 is their code of professional conduct. Our board, HB, in essence has to be in lockstep with what's happening internationally, and these standards come through. Now, the operative date internationally of these new standards for us as accountants is 15 July 2017. We're waiting to hear whether or not the board also adhere to that date or is postponing that date. So, in essence, NOCLAR is actually a mission commission, intentional, committed by a client, the accounting audit firms, by governance or by management, that's you guys, under the direction of a client and contrary to the prevailing laws and regulations. They give these examples of breaches of law, and there are some real life examples over the next two slides. So, in essence, what does this require of you as preparers? First of all, if you're in the C-suite and you become aware of non-compliance with laws and regulations, in essence, you guys have got to fix it. You can't just turn a blind eye to those issues or resign. The obligations are upon you to fix that non-compliance with a law or regulation. So it's explicit. You can't just put it in the too hard basket. So that has implications for how you identify these non-compliance type of issues. It has issues as far as your risk management systems. It has issues as far as making your board aware that you as a professional accountant have obligations which they don't have if they're not professional accountants. If you've got some professional accountants on the board, then you tell them they might not be aware of what these new requirements are. Also, one of the fundamental principles upon which we deal with issues as accountants is the issue of confidentiality. Confidentiality is waived in these particular circumstances. So implicitly there are requirements that if these issues are not rectified internally, not rectified to a high level on something that is significant to the business, then there is an obligation to report to the regulators. And the regulators in these cases may not be ASIC or the ACNC, it may be Fair Work or some other regulatory body. So this is a game changer. And I would think at a point in time that Graham and Sadiq would be taking you through the standard once it becomes issued. In essence, the responsibilities differ if I'm part of the C-suite and an accountant, or if I'm a junior accountant in the organisation. If I'm a junior accountant in the organisation and I become aware of these things, my obligation is to refer it up to the chain. So, does this apply to everyone in the room? The answer is this standard, and the answer is yes. It applies to not-for-profits, it applies to corporates, and it applies to accounting firms, both as accounting firms themselves and auditors. So this is a big change for us. So I've got the action items there. We all need to know these responsibilities. This is a very onerous ethical requirement. Affects us all. We need to really get on top of that one. Otherwise, we as professional accountants will be exposed. So that means that we could be subject to discipline by the accounting bodies. And also, if I just turn the Rubik's Cube for a moment and talk about any issues in relation to non-compliance of laws and regulations, that I can see the no-cloud requirements being used as as a basis for actions against accountants and directors that have done the wrong thing. If I can just have a personal plug for a moment. One of the new services that we're launching is called Report Fraud, which will deal with an independent fraud reporting service where you can get in touch with us and we will relay the fraud or non-compliance on a confidential basis back to the entity concerned. So in conclusion, you can work out whether or not I'm one or the other. So what I want you guys to watch out for is the financial reporting surveillance program, CAMS. ASIC is going to say something about what auditors need to do. NOCLAR, the Annual Information Statement 2017, and the whole issue of whistleblowing generally. That is going to be a hot issue. It's embedded in the union legislation at the current time. Will be a far more broad brush. Will there be a federal ICAC, for example, in the melting pot? So there's a lot going to happen in that regulatory regime. So in conclusion, what I'd like to say is, first of all, will change for 30th of June. The importance of those disclosures on issues not yet operative. AASB 15 and 9 are must-dos, so you've got to get onto those and at least have an idea of what's involved. A little bit later for my not-for-profit colleagues, 1056 and 16, but don't waste the opportunity. If your December balances, start to look at these issues early in 2018. The auditing standards, while they impact auditors in the main, you've got to be aware of the interrelationship between the auditing standards and financial reporting. And ethics is going to be one of those items that we've never perhaps overtly paid too much attention to. We will now be. So this slide basically, if you haven't worked out the subliminal message here, so I'd be pleased to take any questions. Before I take those questions, I'd like to thank Graham and Sadiq for allowing me to share my knowledge and passion. Everything that I've said is my responsibility and reflects not on the good work of Paul Chadwick.
Thanks for the key messages there from Colin on particularly on the new standards coming through, particularly revenue. I know my part, I've spoken a number of times already, that for this 30th of June, I'm expecting to see some papers or memo from the clients outlining the expected impact of that standard, so that those disclosures that for the June are no longer really indicating that we haven't been in a position to assess the impact. I think disclosures now need to reflect some sort of expected impact of the new standard, both at 15 and 9. The other thing which I might mention is that with leases coming in, there's an opportunity to really adopt leases so that those three standards can come together. I think that's right, Colin.
Yes.
And that can save you doing the two standards 1 year and then leases the following year, and try and do all three in one hit. So thank you for that update, Colin. Colin will be here for some time after we finish for any questions you wish to ask him on a one-on-one basis, and same with myself and Sandy and the other members of the team which are here. In conclusion, if you'd like to take some breakfast with you when you leave, by all means. And thank you, Colin.
Thanks very much.